So there's an undervalued dividend growth stock right now that I just purchased. I'm excited to have purchased this stock. It's a smaller position in my portfolio. It's an ancillary position. Nonetheless, it's a meaningful position. It's one that I care about because it's my only dividend stock that I own that's a pure play technology company. And this company right now, it is actually trading, I can't believe it, at a PE, a forward PE for 2018 of 10.58. This company is IBM. So, welcome to the video, everyone. I am so excited to have you here. This is a follow-up to another video that I did on IBM. I'm going to link in the description below. It's one I did a few months ago. And I had a subscriber question recently. Hey, Ian, IBM is dipping. It's dipping a little bit since your last video. Are you buying? And in fact, in my last video, I stated I was not buying because I was trying to focus my 2018 strategic imperatives on consumer non-cyclical, and in particular, Procter & Gamble and Kimberly-Clark. At the time I did my last video, I was pouring most of my available investment dollars into those two positions. That being said, my strategy, it kind of has morphed as this year has gone on. Just because Procter & Gamble and Kimberly-Clark, I'm still picking them up, but they've trended up so much. They've trended up a bit since earlier in the year, and so I'm not deploying quite as much into those stocks as I was in months prior. And so this frees up some investing capital because I do purchase stocks on a monthly basis, and I'm always looking for opportunities out there. I'm always looking. And I actually did a video on deep value investing. I'll link in the description below. I picked up some Campbell's soup, and since I did that, it's increased quite a bit. And so that's out of buying territory for me now as well. But anyways, I'm always looking for these deep values. And when I'm buying stocks, it's not the only thing I look at. I look at pillar stocks. I look at strategic imperatives for the year. I just look at stocks that are core positions that I want to bring to size. But I always have an eye out for deep value. And I just feel like even though IBM, it wasn't really a strategic imperative for me, it's not a core stock, it's an ancillary stock, it's just on sale. It's on sale, so I can't ignore it. And so I want to talk about some updates today. IBM recently released their Q2 earnings, and so I want to talk about some of my personal takeaways from the earnings report. And so before that, though, I want to start with something really interesting. And so back in May of 2018, Warren Buffett, through his Berkshire Hathaway organization, announced, hey, I'm out of IBM completely. And so this drove the stock price down, not only because he announced that, and a lot of people tend to follow Warren Buffett, but also because just the sheer volume of his organization selling the shares probably caused some pressure on the stock, and it's trended down. And so IBM, over the last 5 years, it's been trending down. It has gone from a high of almost $200 up at 196 range. It's now at 145. I like these kind of trends. I like it when everyone just hates a stock. I think when I did my last video, if people hated IBM at that time, they really hate it now. They just don't like it. And I enjoy investing in stocks when everyone is against them, when they are out of favor. And I look at IBM as a really out of favor company right now that is finally starting to turn things around. So let's dig into it. What was announced in Q2? Well, one of the reasons IBM has been under so much pressure for such a long time, and probably one of the reasons that Warren Buffett sold, too bad he sold before they actually turned this thing around, or maybe too bad for him, but not for me, because I got a good price there, and so awesome. Anyways, Q2 earnings, finally, revenue was up year over year, 2% on a comparable currency basis. It's actually up more than 2%, but when you normalize currency fluctuations year over year, up 2%. IBM has been struggling to turn their revenue around. Finally, revenue is starting to grow again, and they're seeing revenue growth across the business. Not in all business units, but they're seeing a broad-based increase in revenue. And most importantly, it's coming from strategic imperatives. Strategic imperatives, they're growth imperatives, they're growth initiatives that comprise 48% of revenue. They're up 12% year over year in terms of revenue on a constant currency basis. So finally, after all of the challenges they faced, IBM is turning revenue around, and I don't believe that has been reflected in the stock price yet. I think there's been just so much pressure from Warren Buffett selling, from just people hating this thing, and just I think in general people tend to fly towards these FANG stocks. When they're tech investors like the high flyers. They don't like the lowly IBMs of the world because they're older school companies, been around a long time. I like IBM because it's been around a long time, quite frankly, because they've had to reinvent their business many times. Some of these newer tech companies who are new, they haven't had to reinvent their tech business. When they hit hard times, who knows if they have what it takes to navigate through. What I love about IBM is they've had a hard 5 years, but they're finally showing the investment community that they've reinvented themselves. They're making it through to the other side, and they've done this before. They've been in business a very long time. I like the DNA of that company. I like the fact that they have this history, whereas a lot of the newer tech players, they just don't have it. And so the earnings per share on a GAAP basis are up 5% year over year. So not only are they experiencing revenue growth, but earnings are up. Net income is up 3%. Pre-tax income is up 14% year over year. So overall, from this Q2 earnings report, I'm seeing some really, really good trends. Numbers are up. Numbers are up, and the strategic imperatives, things like cloud computing, artificial intelligence, those types of things are doing very well for this company. And so I'm just so excited to see them turning it around. And by the way, take a look at IBM's annual report. You'll see that they do so many different things. There are tech companies out there that are really focused. A lot of you ask me, hey Ian, what's your opinion on Apple? I'm going to do a video on Apple. My number one thought on Apple is take a look at their annual report, see how much of their revenue comes from the iPhone. That scares me. They're a $1 trillion+ company that is tied basically to the success of a single product. I think there's a lot of things I like about Apple. If there was a FANG stock that I was going to invest in, it probably would be Apple. But I like something more like an IBM, one, because it pays a higher dividend, but two, because it is more diversified. It offers a lot of different lines of business, and that really comes across when you read their annual report, which is just on their investor relations website. So what else is going on with them? Here's where it gets interesting. They did a full year expectations of what they expect on their earnings per share, and they expect it to come in at $13.80. And they expect $12 billion in free cash flow. So when I take the current share price, which is $145.97, I divide it by the expected EPS for the year, $13.80. That's what IBM says they're going to hit. They're going to hit that or better is what they say. I think they'll surpass it. Let's say they don't. Let's say they just hit what they said they'll hit. The PE ratio, price divided by earnings on a forward basis for 2018, it comes in at a 10.58. Oh my goodness. I love this community. I love you guys, and I'll tell you why. I own 38 stocks. I don't look at all of the details for all of them on a day-to-day basis. I just don't. And I'll link to a video I just did, real controversial. I own all these stocks. Love owning all these stocks. But anyways, one of the reasons I love owning them, because there's always 1 or 2 or 3 of them on sale. Here's one that's really on sale. It's a deep discount, undervalued stock in my opinion. Anyways, it was one of your comments that prompted me. Hey Ian, I know you looked at IBM a few months ago. I know you own it. I know you're not buying it this year, but are you gonna look and reevaluate your decision there, Ian? Because I know you're buying your Kimberly-Clark Procter & Gamble, but things have changed, Ian. Your Kimberly-Clark Procter & Gamble, they've gone up. IBM's gone down. Thank you, whoever did that comment. Thank you, thank you, thank you. I love your comment. It prompted me to look at this thing. It prompted me to do this video, and I made the decision to buy more. And I'm going to be averaging in here a few times now. Already averaged in once, so I'm going to do a few more times here. Want to pick up more. I don't want this position to get too big, but I'm buying more, and it's because of this. I don't own any other stock in my portfolio, to the best of my knowledge right now, that is trading at a PE of 10. Let alone a technology company that is finally growing its revenue, that's doing free cash flow at $12 billion a year, has a history of reinventing itself, making it through hard times, has diversified product lines, has been increasing the dividend like crazy, and gives me exposure to tech, which is important. I mean, I've got exposure through my angel investing portfolio, but in my dividend portfolio, by the way, my angel investing is pretty small. My main focus is dividends. in my dividend portfolio, this is it. This is my pure play tech stock. Boy, thank you for that comment. Anyways, let's go on. Debt. I love this. I want to go into this because I mentioned this in my last IBM video, and I want to add some more insights here. I'm learning more about the company as I go into it. And again, these comments prompt me to do analysis. As I do the analysis, I learn more. Something that's been scary for me and also a lot of other investors in IBM is the debt. It's at $45.5 billion. It was at 46.86 in December of 17. It was at 45.7 in June of 17. Right now, 45.5. A lot of debt. And a lot of people get scared about this. Oh my gosh, how are they going to pay for this debt? Here is what it comes down to. I learned something new about IBM I want to share with you. Two things I want to share with you. I got my computer here. I took some screenshots from their annual report. So this isn't from quarterly, this is from annual. I like to look at the fine print. There's something called interest expense there in the fine print. And what it says is overall interest expense excluding capitalized interest in 2017 was $1.273 billion, an increase of 67 million year over year, primarily driven by higher average interest rates. So they have this debt. They have all this debt. The cost to service this debt is $1.273 billion a year. Okay, we're doing $12 billion a year in free cash flow, and I think they can pay for $1.273 billion a year in interest. And so, yeah, interest rates are rising. Yeah, as they refinance the debt, the interest is going to go up. Let's say it doubles or triples. They still have more than enough free cash flow to cover interest expense. And so I think this 45 billion scares people, but I'll give you another data point. It's not as big as we all think, and this is why. They have other fine print in the annual report that says financial position. It says 31.4 billion is in support of global financing business, which is leveraged at a 9-to-1 ratio. This was a key realization for me. I think a lot of investors, myself included, thought that all of this debt that they have right now at the 45.5, the numbers I'm reading here are a little different because they're from the annual report, the 10K. A lot of investors think, oh, they've just been taken out, racking up debt, racking it up to buy back shares, to do all this stuff, and it scares us. It still scares me. But the fact of the matter is IBM is a bank. IBM is a lending institution. Not all of this debt is just doing share repurchases. Some of it is. Not all of it, though. Most of it, in fact, 31.4 billion of it is for their global financing unit. And so this is the key realization, that IBM is financing other companies to buy their product. And so it's a different kind of risk. I like what I'm learning here more than what I knew before. What I thought before is, wow, they just have a lot of debt, and it's a lot of debt. And yeah, the company's undervalued, and when the share price goes up, the debt won't look so kind of skewed, but still it's a lot of debt. But this gives me a lot of perspective that IBM is a lending institution, and that's why they have so much debt. Now, is that also a risk? Absolutely. Look at GE Credit. GE Credit has had loans coming in bad, people not paying for their stuff. And so the healthiness of IBM really comes down to how well are they underwriting this debt. At this global financing unit, how well are they underwriting the debt? What are the terms of the debt? How likely will the debt be defaulted upon? When interest rates go up, will that affect companies' abilities to repay the debt? Because think about it, if you're a company, you don't only own IBM money, you've got to pay for all kinds of stuff. And when interest rates go up, usually it's a reflection of the economy slowing down. And so if companies out there are starting to hurt and they've got, they owe a bunch of different people money, what if they default on the debt they have with IBM? Who knows? Who knows? And so that is a risk. And so I'm not going to sugarcoat it. I still don't like the debt. I like it a little bit more than I liked it before, just because I don't hear, at least from what I've been reading in the literature, what I've been following with the analysts, I don't hear a lot about debt going bad at IBM. I hear about that happening all the time with GE Credit, with GE. And so this is a very unique nuance that I now learned about this company that I just think I'll have to continue to monitor. And as I own this, as I add more money, it's an evolution. I don't know everything from day one, but I will continue to learn. And what I learned here is I need to really dig into this financing unit and learn a lot more about it. And so put in the comments below, if you're an IBM shareholder, let me know, what do you think about their financing unit? Have you digged into it more than I have? I'd love to know what you think about it. Are they underwriting well? Are they not underwriting well? Topic for another video. I don't want the video to be too long today, and I only had so much time to do the analysis, so there's always more analysis to do. A shareholder, an investor, dividend investor, cash flow investor, we're never done with our analysis, but you know, it just comes in over time. Anyways, what else? Dividend. I invest for dividends and cash flow. I love dividends, passive income. The dividend in right now is $1.57 per quarter, and 5 years ago it was $1.10 per quarter. It's up 43%. That's the big news, is the dividend here is up 43% in 5 years' time. And so the current yield, the starting yield, if one were to buy shares in IBM right now, like I just averaged in, it's a 4.3%. Not a bad starting yield for a tech stock that's growing their revenue, that I think is on a turnaround path here. I'm pretty excited about it. World-class name. Here's the deal though, yield on cost, if they can raise their dividend at the same rate in the next 5 years that they did in the last 5 years, I calculated. How would I do it? I take my $1.57, which they're paying per quarter now, and multiply it by 1.43. That will raise it by 43%. I take that, it comes to 225. I take my 225, I multiply it by 4. That gets me the annual dividend, because the 225 is the new quarterly dividend. Divide it by my current purchase price, which is this current share price of $145.97, and I get a yield on cost of 6.2%. So if IBM can continue to raise the dividend at the same clip that they have for the last 5 years and the next 5 years, I will be yielding on cost on my purchase price 6.2%. So, and that's without reinvesting dividends, by the way. That's just a pure yield on cost, assuming I spend the dividends, which I don't. I reinvest them, so it'll be even better than that. But that being said, pure, easy, simple yield on cost, not bad for a tech stock, and so I like that. Here's the deal. One other thing to think about with IBM, a lot of pros today. Pros is, I think the thing is just undervalued, bargain basement PE, revenue's growing, all this good stuff. Warren Buffett's out. It's created a buying opportunity. Cons, obviously the debt. The debt's still big. I like the debt a little more than I did before, because I actually think there's a purpose behind the debt now. They're financing people to buy their product. That said, it would be sure nice if they didn't have to do that, if they could sell their product without financing it. So always a risk with financing, and so anyways, that's something I'll have to learn more about. I feel a little bit, I'd say on a scale to 1 to 10 before, if I disliked the debt at a 10, now maybe I dislike it at like an 8. So it's a little bit less dislike for the debt than I had before, but I still an issue. Global financing, that'll probably be the reason it's always going to be a smaller position for me, ancillary position. They also have a lot of retirement plan related expenses. I was reading about this in their annual report. It seems like they have it under control. Seems like it's funded well. It does seem though like the pension plans, the returns that they received on their investments last year weren't as good as they hoped, so they had to then put more money into it. With any of these older companies, pension plans are always going to be an issue. IBM's got it. I think they got it under control. Again, in comparison to free cash flow, it's down there, although it's actually a bigger expense than their interest income, believe it or not. Interest in financing expense. So I thought that was really interesting. So it's a new thing that I'm kind of flagging there as a con. And so as with any investment, there's pros and cons, and the pros and cons help me weight. One, if it makes in my portfolio, not all positions are equal, and this one will always be an ancillary position for some of these cons that I'm mentioning today. But I like having the exposure. And I'll tell you, at the end of the day, the way I look at IBM is it's almost like an option. In the short run, I'm getting paid my 4.3%, where is it? Yeah, 4.3% starting yield. Love it. It's going to keep growing. I'm going to get some steady Eddie capital appreciation, which I don't really care about, but it will be a reflection of the company rebounding here, and revenue will be up, earnings, all that good stuff. Steady Eddie will be fine with this company. But The beauty of owning companies like this is it's got an option. There's an option here. And the option is if something like Watson just takes off, their artificial intelligence, it could take off and this whole thing could hockey stick. And so I'm being paid in the short run. And I don't have this dynamic with some of my other companies. We talked about Procter & Gamble, Kimberly-Clark. They're more steady Eddie. And I love having steady Eddie because those companies are really robust. They're disruption proof in many respects, in my opinion. Tech companies are not disruption proof. They are always innovating, but this one at least has re-innovated so many times, so many times. But anyways, what I like about this company is I think that it will be steady Eddie, but it's that option. It's that option that, wow, if Watson really takes off, this thing could 10x. If I have a company in my portfolio that could 10x, this is one of them at least. Surely angel investments, but from a dividend standpoint, and think about it, if this thing 10x'd, if it got to, $1 trillion market cap one day, what would that mean for the dividend? And so they already have a really shareholder-friendly policy on dividends, much more so than most other tech companies that I track at least. And so I like it. So anyways, thank you for the comment, the question. I'd love to understand what you think about IBM, where you think it's going. Do you like it? Do you dislike it? What are your thoughts? Please share them in the comments below. This is a thriving community of dividend growth investors. We are here supporting each other in our quest for cash flow, financial freedom. My goal is to completely live off of dividend income one day, and I just love this. Even though my expenses aren't fully covered now, I get dividend checks from companies like IBM on an ongoing basis, and I reinvest them now, but if I don't want to, I could start using that cash flow tomorrow to start paying bills. So I just love that about dividends. Before I leave today, in terms of a full disclosure, I own many of the stocks mentioned in today's video. I am a shareholder. I am long on IBM, ticker symbol IBM, Campbell's Soup, ticker symbol CPB, Procter & Gamble, ticker symbol PG, and Kimberly-Clark, ticker symbol KMB. I own all of those stocks in my personal stock portfolio. Also, before I leave today, in terms of a disclaimer, I'm not a licensed investment advisor. Today's video is not investment advice. This video, it's just for your fun and entertainment. If you're going to go out and invest money in the stock market or anywhere else, please consult a licensed financial advisor first. Hey, if you enjoyed the video today, you like this channel, the best way you can thank me is by subscribing, commenting, liking. All of that means the world to me. And if you want to get bonus points, head on over to my Instagram. I'll link in the description below. Would love to see you there. That would mean the world to me as well. Thank you. Thank you so much for being here. I will see you in the next dividend investing video.